What is factor investing? Hey, welcome to Dow's Stock Talk, where I talk about topics relating to investing in finance, but more specifically, these stock markets. In this video, I'll be going over what is factor investing. But before we get started, make sure you smash the like button because it helps the YouTube algorithm. It helps YouTube know that this is quality. You know what? I want to give you some content first, and then I'm going to ask you to smash that like button. But anyway, factor investing is a strategy or style in which you determine what types of securities you're going to get based off of factors. Video done. Okay, so let's try to go over what factor investing is without using the word factor. Factor investing is an investing strategy or style in which you use specific attributes to determine what type of security or stock or bond that you particularly purchasing. It's based off of characteristics or attributes. Now, not to give you a history lesson, but it all derived from a study that they did in 1960 called capital assets pricing model that came in 1960, which then evolved to the efficient market hypothesis. I don't want to get into that too much, but it's pretty much that states that the market is priced in all known information, and as new information comes in, it is immediately reflected in the stock market. But let's not get in that too much. Now, but the whole purpose of using factor investor is to typically outperform the broader market based off of a systematic approach where they use specific attributes. They base it off of those attributes. They pick a large selection of companies that meet that attributes, and over a longer term, they're hoping to outperform or have the companies that has the highest probabilities to outperform the broader market. So there's two major factors that determine returns over a long period of time. Those two factors are macroeconomics and style factors. Okay, so what would include as micro factors and what would include as style factors? Microeconomics would include things like inflation, interest rates, GDP, economic growth, things that affect the broader market on a global scale, even credit, the national debt and stuff like that. All of that would be included in the microeconomic factor. Then you have style factor, which would include something like market cap, small cap versus large caps, value, growth versus value, where you try to find companies that are undervalued based off of their current performance. Then you have quality, where simply you're probably looking at the company's fundamentals, making sure they're sound and like that, good cash flow, low debt, great balance sheet, things like that. Quality is open to someone's opinion. Then you have momentum, which momentum states that if the stock has been doing well, it will continue to do well. So momentum, you have that. And volatility, which basically you can think about it as the beta, which determines how much volatility that the stock have or how much fluctuation that the stock have. So those are the major attributes as far as style factors. And a lot of times people just recently threw in profitability. These are attributes that you can look at over a longer period of time that tends to outperform the broader market with these particular attributes and factors that you will look at. Like, for example, small caps tend to perform better than larger caps over a longer period of time. Value, that they kind of recently did a study, value outperforms growth over a longer period of time. These things are subject to change, but I just wanted to know based off of the research. Companies that have higher capital and returns tend to do better. Quality companies with low debt, great cash flow, stable earnings, consistent growth does well normally over a longer period of time. You got the momentum. Stocks that are appreciating will continue to appreciate. Most of the time, for I think momentum, you're looking over a certain time period, maybe 3 months to 1 year. Risk volatility, stocks that have lower volatility seems to do better over a longer time. And the next one they add, profitability. So companies that are profitable tend to, over a longer time, to do better than companies that are not. So with the factor marking, you're picking a basket of securities, not just one, because you're looking for overall trends, overall characteristics that tend to outperform. So if you're looking only at one, that may not be true. But if you're looking at the overall characteristics of those particular companies, because you're basing it off of your rules, the theory is to outperform the broader market. Okay. and usually factor investing is done with the form of an ETF, exchange traded funds, which you can just trade it like individual stocks, but it consists of a basket of different companies or securities. There are three major advantages about factor investing. It can improve portfolio outcome, reduce volatility, and enhance diversification. One thing I would like to say, my personal opinion about factor investing, I think it can do well, but the problem is market cycles tend to be a big role as well. So you kind of would have to know the market cycle, which can kind of be difficult to do. Like, for example, if you knew that the bull market would last 5 years, then those particular characteristics would be way more effective. But understanding what type of market cycle that we're particular in can be quite difficult, which different market cycles, certain characteristics perform better. Some things about the study that may be on the downside of a lot of the stuff wasn't tested during different types of bear markets, different type of market condition. They do back testing and stuff like that. And you also got to remember personal biases, where if you look at every single scenario, multiple scenarios, some may have just worked by chance as well. So if you try a lot of things, it could have been necessarily that it worked by chance versus a systematic, efficient way. Yeah, so let's go over some advantages and disadvantages. Some advantages: it helps enhance returns, helps reduce risk, improve diversification, systematic approach, and it removes emotion. Now on the disadvantages, it can be too heavily focused on one factor. As far as, like I said, the market cycle, different market cycles, these factors may be very based off of different market cycles, which I mentioned before. Now, a lot of times when I looked at these factor ETFs, it appears that a lot of them is kind of heavily based off of one factor. Now, I found a few that use multiple factors, so it looks like a lot of them kind of really focused on. I checked out a couple one, like they have a momentum ETF, which is called MTUM. So it looks like they focus mainly on like one or two main factors to really put that fund together. That's what I've kind of noticed, that a lot of them really focus on one particular factor when you're looking at that particular fund. They have, like, for example, a value fund, which is VLUM. I'm just throwing out different ones if you wanted to check out what type of, what can be included as like a factor ETF. Vanguard have a couple one for each one. Like for value, they have the Vanguard US Value Factor ETF, ticker VHVA. For like quality, they have a Vanguard US. And they also have, like, I'm just going over different ones so you can kind of get an idea. And they have different companies and stuff like that. They have the Vanguard US Momentum Factor, ticker VHMO. They even have a Vanguard US Minimum Volatility ETF, ticker VHMV. So yeah, they have all different types of factor investing ETFs. I'll put some tickers on the screen that would include different types of factors ETFs that you guys can check out. And a lot of times with factor investing, there will be time periods where you underperform the market, sometimes for years and things like that. So a lot of times with factor investing, you can underperform the market for a good amount of time. But it's also good to mention that in general, that a lot of hedge funds and mutual fund managers, over a longer period of time, they don't outperform the market. Some outperform the market for maybe 5 or 10 years, but going forward, the longer the time period is, the more difficult it is to outperform the market. So I just wanted to kind of let you know. That concludes this video. Let me know what you think about it. If you haven't already, make sure you hit the like button. If you're new, make sure you subscribe to my channel.